Welcome to the Broken Pie Chart Podcast, episode 118. I'm your host, Derek Moore, and this week, going to be responding to a few questions I got about this. You might have seen it on Bloomberg or CNBC. The Federal Reserve went in and did some big activity in the reverse repo market, which are reverse repurchase agreements. So what the heck is that all about? What are these repo markets, reverse repo markets? How do you figure out what the reverse repo and repo rates are? What exactly is changing hands here? Are these collateralized loan obligations? What's going on there? And then are there other cases? So is it always the Fed and Treasuries, or are there always cases where these loans take place? Who is doing them? Why are they doing them? What does this mean with regard to the Fed funds rate? Does it mean anything? So before we get into all of this stuff, let's just start out with, a simple example. Let's say you own, $1,000 worth of 10-year treasuries or something like that, right? You got $1,000 in a treasury bond. But you need some cash. You need a little bit of cash. So, and why do you need cash? You just do, right? For our purposes right now, you need cash, and you need to borrow cash for about a month. So you call one of your friends, and I'm making this as simple as possible, but I like to do that. You call one of your friends who has cash and says, "Hey, can you loan me, $1,000? And in a month, I'll pay you back," right? And your friend says, "Sure, but let me hold on to something. I want collateral." And the collateral is something where your friend's like, "Hey, give me the collateral, because if you can't pay me back, at least I have this collateral," okay? So what you're doing is you've got this one bond worth $1,000, and you're like, "Hey, I need cash." So you're going to do what's called a repo agreement. And what that means is you're going to give the bond to your friend, and your friend's going to give you cash. Now, in reality, these are big banks. It's the banks and the Fed. It's, different things like that. But let's keep it simple. So you hand over your bond to your friend. Your friend hands you $1,000. And over the next month, you're not in theory, you're going to pay some rate of interest. It's a repo agreement because basically you're going to repurchase your collateral back from your friend. In this case, it's in a month. Okay, so you have the bonds, you give them to your friend gives you the $1,000. Great. You've got a liquidity need for a month. At the end of a month, you give $1,005, $1,005 back to your friend, and you repurchase your own treasury bond back. You get back the collateral. And so to figure out how much you paid, basically it's the 1,005 divided by 1,000, and then you subtract it by 1, by the way. You get, 0.5%. So that was the repo rate that you paid. That's sort of the interest, because you paid a higher price for the asset. When you repurchased it, you paid more for it than you got in cash. And so that difference is similar, like if you have a stock, you buy it at 1,000, you sell it at 1,005. The difference is what you make. Well, you borrowed $1,000. The price of the bond was 1,000, but now you pay it back. You pay a premium to your friend. So your friend collects basically 0.5%. And if you want to annualize that, you would take 1,005 divided by 1,000 to the power or exponent of 4 minus 1. It's a little over 2% annualized yield. So basically what's just happened is that's a repo transaction. And the repo rate would be listed on that at 2.02%, because they're always listed as annualized figures, but in reality, That cost you about 0.5%. So again, why did you do that? Why didn't you just sell the bond? You had a short-term liquidity need. So a lot of times, sometimes these agreements are just overnight agreements where party A just needs funds for, basically one day or overnight. It could be a week, a month, 180 days, could be a year, right? And it's sort of like a collateralized loan. You get a loan, you put up collateral, but the repo, the term which is repurchase agreement, just means you're going to repurchase your collateral normally for more than you lent it out for. And that's how the counterparty makes a little bit of interest there. And the repo rates are going to be dependent upon the underlying collateral. So imagine you gave your friend, you're like, hey, here's $1,000 worth of Bitcoin. And you're like, I'll buy it back at 1,005. Well, that's not going to fly, right? Because what's the risk? The risk to your friend who's holding on to that collateral is that you can't pay them back and the asset drops. So imagine if it was Bitcoin instead and you can't pay your friend and Bitcoin goes down by 70%. Now your friend's got an asset that's worth, $300 instead of 1,000. And so they're taking on market risk. And so, but with treasuries, especially short duration treasuries, like 3-month T-bills, things like that, 1-month T-bills, you have a little bit of market risk, very little interest rate risk, and very little default risk because they're U.S. treasuries. We can always print more. Okay, so that's kind of the basic thing here. So who's using this? Well, so typically this market is your banks, could be brokerages. I saw an article recently that T. Rowe Price and Vanguard were recently added to the Fed's list of authorized repo market participants or reverse repo market participants, but I'll get to that. And a lot of times, just one firm or a bank might have a short-term need for liquidity, and that's why they do it. You also could see this. You might see a corporation do a repurchase agreement where they put up collateral. In this case, it's a collateralized loan, and they get funding. Maybe they have to fund a purchase order, and they have a short-term funding need. So sometimes those are done in commercial markets, but it's kind of the idea. Okay, the reverse repo is a little bit different, and here the reverse repo is you've got cash, and you're able to lend out the cash, but you're going to take in that collateral. This is what the Federal Reserve did last week, is they actually went out and they took cash out of the system where banks or money market funds, that's why you see like the T. Rowe Prices and the Vanguard, there's excess cash in the system. And so they actually, again, is that it's the reverse, right? Okay, so sometimes this throws some people. So let me just go through this slowly, and then we'll kind of get to what the Fed's doing and some of the participants. Okay, so we already said a repo, somebody has collateral, they need cash. A reverse repo, what just happened the other week, is all these banks, maybe all these funds, they've got cash, and they want to get rid of the cash. And in this transaction, the Federal Reserve did a reverse repo agreement where they exchanged collateral, treasury bonds, for cash. And so it's, and I don't want to say a repo agreement or a reverse repo agreement is sort of, you just look at the party and what they have to bring to the table, whether it's cash or whether it's collateral, because there's a little more involved than that. But that's sort of the way to look at that, okay? So reverse repo is you've got cash, you're going to ship it out, you're going to take in securities, or in this case, treasuries, and the other side has collateral and they'll take in cash. So why did this happen? at the Fed, right? And was what happened, was it unprecedented? So I went back and I looked, and this is on the St. Louis Reserve, Federal Reserve Bank of St. Louis site, otherwise known as Fred. Anytime you want to get, tons of stuff on there. If you Google Fred and you put in whatever you're looking for, a lot of times there's a chart. And so the repurchase agreement market actually in, I guess it was September of 19, that's where you saw the opposite. You saw the Fed injecting liquidity, putting dollars into the market in exchange for treasury securities from banks and different counterparties, okay? That really has not been used at all since, let me look here, probably maybe July, June or so. Yeah, kind of like June of 2020. And at the very height of it in March of 2020, there was about 100 billion, I think. This is in millions, so maybe 100 million in there. I'll double check there. But it hasn't been used since. The opposite, though, where you basically had a reverse repurchase agreement, and that's where Treasury sold by the Fed in, what's called temporary open market operations. Back in April, you had, the previous one I said, that was 200 million. This one is in the billions. So it's about 230 billion. That was in April of 2020. But recently what we've seen is it actually hit an all-time record. On Friday, for example, it hit 479 billion. The day before, Thursday, May 27th, was 485 billion. And really there wasn't much at all going on in that market until it started to crop up again, February of this year. There was a tiny blip in January. You got to go back to, sort of the last time things were this big, where if you look at, 2014, 2016, 2017, 2018, and there you had some highs around 400 billion. So that's kind of what you're hearing. And there's a couple schools of thought. There was an article in the Financial Times, FT, where they kind of looked at this and said, a lot of these money market funds or banks, they've got to park their cash somewhere. They have too much cash. And with Treasury bills pushing negative rates, even though they're essentially getting 1 basis point, next to nothing on the reverse repurchase agreement, that was at least a place where the yield wasn't negative. And so that's the other thing, and I'm not sure how big of a deal this is, but the Treasury, I believe the U.S. Treasury has cash on right now that they've got to wind down a little bit, and it's technical reasons, and it goes back to some of the tax bills or some of the things, governmental operations, right? But I don't believe, the last time I checked on a short duration, so bills are different than bonds. Bills are less than a year. Bonds are greater than a year, right? So if you look at issuance of 1 or 3 month T-bills, the demand for those has outstripped supply. And that means at auction, means when the government first auctions it off. And so there's not a lot of really short duration Treasury paper out there, of Treasury bonds, or bills. So that could be one of the reasons. I've seen some commentary on that. And is this kind of a quasi-quantitative tightening? I don't know yet. And the reason why you're hearing that is that the Fed essentially is, instead of buying bonds, it's actually taking in cash. And it gets a little bit complicated from there. But there's some people saying, hey, this is a sign that there's too much liquidity out there. So potentially that is something to look at. And if it turns out that the market can't absorb any more, liquidity, and there's too much sloshing around, sloshing is a term that people used on TV, then maybe this is a signal of something. But I think it has more to do with the fact that the Fed funds rate, so the Fed funds rate is, it used to just be a single number, and now it's a range. So right now it's 0% to 0.25%. So a quarter point, 0 to a quarter point. And the Fed funds rate has been, I think last time I checked, it was around, 6 basis points, which means, 0.6 of 1%, right? And so part of the argument too here is that the Fed wants to keep the Fed funds rate from going outside the range, meaning going negative. And this is a way for them to try and stop that from happening. So kind of more of a technical thing here, but that's definitely one of the aspects to look at. So one of the other things too to take a look at is recently the Fed has increased the number of authorized participants in this. And I believe they also increased the limit from 40 billion to 80 billion. And according to the Financial Times article, some 50 participants parked 485 billion at the U.S. Central Bank through its reverse repurchase program. And of course, that's run by the New York branch of the Fed, so the New York Fed. And by the way, the previous record was 474 billion on New Year's Eve in 2015. By the way, just a note on the timing of this. Often you see spikes like this, or you have seen spikes like this at the end of quarters, at the end of year, and this was done not at the end of a quarter, not at the end of a month, so that was a little bit interesting. There is, by the way, a list of authorized participants on the New York Fed side. If you're so inclined, you can go check that out. And I think I mentioned this too. A lot of this has been coming from money market funds. And so the Financial Times article pointed that out as well, where they said, look, with the Fed buying 120 billion of treasuries and agency-backed securities each month, along with the federal government putting out stimulus checks to aid the pandemic recovery, money market funds have attracted inflows. And basically banks, for regulatory reason, this is all in the article as well, they are shifting deposits to money market funds. So it seems like that's where some of the funds have been coming from. If we look at a few of the benchmark rates, so the Fed funds rate, as I mentioned, hit 6 basis points. I've seen it as low as 5 recently. It's been 7. If the target rate is 0 to a quarter point, they don't want it to get outside that range. And so that's some of the potential reasoning for why they're in the market. By the way, a few other things of note, the SOFR rate, Secured Overnight Financing Rate, SOFR. If you've taken out a loan recently, and you might have remember things used to be based on LIBOR, people are going away from LIBOR, and SOFR is supposed to be the replacement for LIBOR. And that rate is down to 1 basis point, so 1/10 of 1%, so 0.01, right? And, that's almost 0. And so, a couple people have mentioned part of the reason why they're going in here is because they don't want these types of rates to go negative. There's another theory, too. There's something called interest on excess reserves, and IOER rate. And the interest on excess reserves is currently sitting at 10 basis points. So that is, I guess my other one was 1/100th, right? So so IOER is 1/10 of 1%, 0.1%, right? And that one has been sort of holding. That's one to take a look at, because the Federal Reserve could actually move that rate without actually changing the Fed funds rate, which is, of course, the big one that you always hear about, interest on excess reserves. Just a little background on that. The Federal Reserve started paying interest on excess reserves probably back in, I don't know, it was '08, somewhere around there. And that was, I think it was part of a bill that got passed in Congress. And that's the idea is banks could go ahead and put their excess reserves on deposit with the Fed, and the Fed would pay them an interest rate. So that's one that they could move. They could actually increase the reverse repurchase rates. I think it was noted that they're essentially zero, although it did tick down to negative 0.01% at one point. So that's something they could try and increase as well. And all those things are really about just keeping the Fed funds rate within their narrow band. They don't want it to get outside of the narrow band. So, okay, so let's kind of backtrack a second. And so does this mean anything for the markets? Don't know yet. It's, the Federal Reserve, this is a little bit new that they were in the repo market. It's not new that they are in the reverse repurchase market. As I mentioned, 2016, 2018, 2014, they were in the market. Is this a spike compared to what's happened recently? Yeah, it is. So I think we'll just have to see on this. And, the Federal Reserve has done a lot of things that they never did before, including buying corporate bonds. They bought mortgage-backed securities since 2008. They've done Operation Twist, QE. They've done yield curve control of late. So a lot of different things that they're doing. And this starts to get into the minutia of the inner workings of the Fed. But to be determined, and we'll see. I do think part of this is there's just too much money chasing too few T-bills, and there's nothing available. So seems to be like a market that those people looking for, a 1-month T-bill or something would go ahead and gravitate towards. So I'll link to a few things. I'll link to the New York Fed site. I will link to the St. Louis Reserve Bank, Federal Reserve Bank of St. Louis, that shows the repo rates and the repo activity. So you can take a look at that. And then even on, the page I'll link to, when they talk about the overnight reverse repo operations, right on the New York Fed's page, they even say the overnight reverse repo program, or ON for overnight, RRP, is used to supplement the Federal Reserve's primary monetary tool, interest on excess reserves, for depository institutions to help control short-term interest rates on RRP operations, support interest rate control by setting a floor on wholesale short-term interest rates beneath which financial institutions with access to these facilities should be unwilling to lend funds. So basically what they're saying is right now they don't want rates to go below their 0 to a quarter point bound. And to do that, they're essentially offering rates which are 0% or 0.01%. Basically, they want to set that floor. So if they're in there and they're setting that floor, somebody lending out money shouldn't take something less than that. Okay, and that's really the crux of what's going on right now. What that tells me is there's some real pressure on short-term rates, where if the Fed didn't come in here, potentially maybe they'd go negative. So a little bit of in the minutia here, but I wanted to make sure and give you an idea of what these terms mean: the repo market, reverse repo market, who's in there, what's the Fed doing, and things like that. Okay, so now do me a favor, please share this episode or share any of the episodes. We've got, this will be 118 now. And this month, by the way, was the month's not over yet, but it's the most downloads the program's ever had. So that's really nice. You must be sharing it or at least listening. And, you can also rate it 5 stars and review it as well. I always say don't bother doing that. But go ahead and share it. That's a better thing. All right, folks, we'll be back next week with another episode.